Hi there, I've got a question for you. How would you like to earn an 11% return on your investments by investing in Class A real estate assets at Class D prices? Adam Gower here, and in today's podcast, my guest Ryan Windley has created a model for investing on the Groundfloor platform that has yielded him outsized returns relative to the risk he's taking. Groundfloor is a real estate crowdfunding platform that provides first position loans to fix and flippers. They grade the deals on the platform, and Ryan, who is a passive real estate investor, as well as being a teacher, has figured out and successfully tested a different way of analyzing their deals that reduce risk while increasing returns. To find out more about Ryan, go to the podcast page at gowercrowd.com, and while you're there, be sure that you click on the subscribe button at the top of the page to gain access to our free weekly newsletter. We're the only website exclusively dedicated to real estate crowdfunding and syndication news and updates. We're going to get information and resources that you can use immediately. It's totally free and it's there at gowercrowd.com. All right, now on to Ryan Windley and his secret hack to increasing returns while reducing risk. You're going to love this. Here he is. Ryan, what a pleasure to meet you. I've been so excited to talk to you. You know, I saw you on LinkedIn. I'm actually going to read your title on LinkedIn, but then we're going to chat a little bit. So you say, I deconstruct real estate and real estate crowdfund investing. How interesting. Talks about hashtag real estate crowdfunding, homie, leadership, and rich dad. What an interesting background and story you have. Why don't you tell me, what is your background? Who are you? What do you do? And then we'll start talking about all these fascinating topics, especially that one that I contacted you on in the first place. We'll get to that later. Who are you? What do you do?
Thank you, Adam. It's been a pleasure getting to know you, and it's been a pleasure. It is a pleasure being on your podcast. You know, as my podcasts go, there are two podcasts that I greedily consume whenever they drop, and I drop everything and I listen to them first, and that is Tim Ferriss and your podcast.
Oh, thank you. Oh my goodness. Can we stop there now while we're ahead? Let's just cut right there and I'll send that out to everybody. We're good to go with that. You're very kind. Thank you, Ryan.
I really enjoy the guests you have on. I've learned a ton from the guests you have on. It's very educational. I thank you for doing it.
My pleasure. Thank you.
So a little bit about me. I was raised in a sheep and cattle ranch in the Wasatch Mountains of northern Utah. My hometown is so small that when I left town, they changed the population on the sign to 119 from 120.
That's crazy.
Yes.
Wow.
So real estate's always been a part of my life. I enjoy real estate. I really very much enjoy rental real estate, and I've been a property manager. I manage my own properties as well as other people's properties, and that's a hard business. It's a tough business, especially on a small scale. So that's why when I first learned about real estate crowdfunding, I became so intrigued in it because it's great to invest in property without the headaches.
And you have, so what the reason that I contacted you in the first place, apart from your LinkedIn profile, it was quite intriguing as well. I think you might have commented on one of my posts, so thanks for that as well, was that you talked about Groundfloor and that you have developed some kind of analysis you're very happy with. First of all, tell me, for those who are listening who don't know what Groundfloor is, one of the crowdfunding platforms, tell me the story of how you came to Groundfloor, what they do, and let's get into your analytics and your experience with that particular platform.
I believe I was perusing the website Bigger Pockets, and this was maybe 3.5, 4 years ago, and I saw it mentioned, and I thought, that's interesting. I need to investigate this. And then as I looked into it, I thought, wow, this is really cool. And then I signed up, and I started with a small account, and I applied our method that I learned through being a Rich Dad coach. I was a Rich Dad coach for over a decade, and this is the same method that we would teach our clients in how to evaluate rental real estate.
Oh, that's interesting. Well, I'll tell you what, let's just pause right there. What is the method? What is the
Well,
Rich Dad method?
well, this is a method that the coaches and I came up with to help teach new investors the important part. And I'll explain it like this. Every morning I go on a walk on a trail system that's in my community, and it goes up into the mountains and passes a lake. But one morning I was walking on the trails past the lake, and I saw an osprey, and this osprey was circling. And he was circling, and his circles became tighter and tighter and tighter. And then all of a sudden he just dropped into the water, and he came out with a fish. It's the exact same method. You start wide with a geographical area, and then you research it and you research it and bring that circle smaller and smaller and smaller. And then you dive in and you buy a property. The method is really, you want to look for markets that are growing and expanding, where there's jobs, where the economy is good, where the prices of real estate are good compared to people's income. We taught something called the 5-to-1 ratio. And the 5-to-1 ratio says that when the median home cost is 5 times greater than the median household income, that tells you that things are starting to get a little bit expensive in the area.
Mm.
And that's not necessarily a bad thing, because it means that more people will be renting than buying. And I would show my clients how to utilize free websites on the internet to dig and research this information.
Oh, that's really interesting. So what about Groundfloor? What is it? I mean, you and I know what it is, but for that one person in the audience that doesn't know what Groundfloor does, just tell us a bit about the platform and how you found them, and what do they do exactly?
What Groundfloor does is they lend money to house flippers, that would normally be the domain, and for years have been the domain of wealthy individuals who lend hard money to home flippers. And that money was very expensive. Now they can go to Groundfloor and they can get a fixed interest rate with low points, and get the money to buy a house and flip it that way. Then Groundfloor opens up those loans for non-accredited investors, just regular folks, to invest in.
Right, and they so they set up they provide the capital to a fix and flipper. Let's pick a number. I'm going to pull this out my ear. I know it's changed since they started, but let's just say they charge 12% to that fix and flipper. Right, it's going to be a short-term loan over a 12-month period or so. 12 months with maybe an extension right for another 12 months. But basically, they'll charge 12% for that loan. They charge points in and out. The technical term is in and out, meaning they'll charge points to get the loan, and they charge points when they pay off the loan, and they might charge an extension fee as well, right? Points meaning percentages of the amount that's being borrowed. Now, they then go to individual investors on their platform, and they say, look, we've got this loan. It's a $500,000 loan or $1 million loan or $2 million loan. It's paying 12%. Would you like to invest a small amount into that loan? That's how it works, right? Basically.
Yes.
But they grade the loans as well, don't they, at Groundfloor? So explain what that is and how that works. So,
in my opinion, I think they misgrade the loans. That's my personal opinion. And therein is where there's some opportunity for an investor like me. They grade them on different factors, and they grade them on loan to value that every lender would. But I really don't trust, and I say don't trust, but I don't have 100% confidence in the after repair value, the ARV that these investors say this house is worth. And Groundfloor doesn't provide a lot of information for me to really dig in and say, is this project feasible or not? So what I do is I do my own investigation, and I say, okay, based on the economy of this city, based on the property values and how much they've increased, and it looks like they're trending upward. And the vacancy rate, I like low vacancy rate areas because it tells me that there's demand there. I will invest based on my analysis, not on Groundfloor's grades, because I haven't found a lot of correlation between their grading and my success.
That's really interesting. All right, so that's fascinating that you find an opportunity. I absolutely love that. So you also described a portfolio that you put together based on your analysis of Groundfloor deals and your investments. Tell me about that.
So I've invested over the past 3.5 years into 280 some odd loans. And of those, only a small fraction, and I'm talking like just a handful, I can count them on one hand, have actually been lost money, have gone bad and lost money. Some will be repossessed by Groundfloor and they break even, but only a handful have lost a slight amount of money. As far as portfolio management goes, I only place 2% of my overall pool of capital. I only place 2% into one loan. I don't go whole hog onto one, just because Groundfloor hasn't given me enough information for me to feel comfortable in, yes, indeed, is this a good loan or not? My analysis is based on, if this house flipper were to turn this project and, well, if it were to just all go down the toilet, would there be another house flipper waiting in the wings to take this project over? And that's a function of pricing. What price did they buy it at? What's the value around it? Those are the values that I look at.
So 2% suggests that you maintain at any one time 50 investments with Groundfloor. Is that correct, to get to your 100%?
Yeah.
That's a lot of work. So what's the process that you go through, and what kind of returns have you seen, and like what's been the historical perspective of all that?
Over those 3.5 years, I've maintained an 11% return. It's fluctuated slightly. At one time in the early days, it was at 12, but now it's gone down to 11. It's gone down a little bit more to 10.9, but then it's bounced back up. Hopefully that'll continue. With the upheavals that's going on in real estate right now with interest rates, we'll see. But I've invested in so many properties at one time in small amounts that I just the sheer numbers of properties, I don't see it changing drastically.
Well, except that interest rates presumably will go up, including hard money loans, including loans that Groundfloor are making to their investors, right? Those 12% are going to go to 13s and to 14s or whatever. So presumably you will see some upward trend. Have you seen any indication that rates are going up for loans to fix and flippers via the platform?
Yes, actually, Groundfloor has increased the loans, I think, a whole percentage point, 100 basis points on their loans. I think they did that last month.
And what's interesting, you say, so you've got this, you feel like you've got this edge. I do love that, by this, it's really interesting. That you have a different analysis. And please walk me through this, because I'm just going to do this from memory. I don't have their website lined up, but the way I understand it is that they have they're going to grade them. I should look. You will tell me, but they grade them A, B, C, D, E, and F, or something. A, B, C, D, and E. And if it's an A, it's a lower risk, so you get a lower percentage. If it's an E, it's perceived to be a higher risk deal, So you get a higher percentage of return on it. So if you're seeing those, what I'm understanding you're saying is that you're seeing some of those higher percentage deals, those E-class, DE rated deals, but you think that no, these are actually C's and B's. So you're investing in those. That's a lower risk, but you're getting the high risk. So all right. So now I've kind of guessed it. Tell me more. Give me the specific jargon. Explain what you're seeing, and how are you beating their system?
Well, their numbers that they're looking at are loan to value. They're looking at, is this flipper full-time or part-time? Who knows, right? I mean, are they really going to tell you that, yeah, I'm only a part-time person? They also look at the area, and I don't know what goes into their analysis of the market, but I like my analysis of the market. And so I feel very comfortable in investing in those D&E loans if they hit my criteria of a growing, expanding market. People are having jobs there. There's a low vacancy rate. So that's where I feel comfortable investing in something that pays 14%. I just had a 14% return pay today. I should say 14% interest on the loan repay today. And that's supposed to be graded as a D or an E because it.
But you considered that to be what? A B, an A, a B, or a C? You thought that
I considered it to be an A.
Fascinating.
Now,
and what do they pay for A's? What do they pay if you invest only in their A graded deals?
Oh, you're at like 6 to 8%.
Got it. So that's the point I'm making. So you're investing, you're getting an 11% return on what you consider to be A-class investments over there that would otherwise only pay a 6 to 8%. That's the delta that you're getting at. 3 to 5% delta over their results. That's extremely interesting. So now I'm going to ask you for a couple of secret sources. You don't have to tell me if you don't want to. But what are the tools that you use to evaluate deals, to look at vacancy rates and population growth and employment, etc.? What are the top 3 tools that you use to evaluate a deal?
So, because I'm cheap, I use free tools. So the tools that I use are bestplaces.net and Redfin.
Oh.
So I use bestplaces.net to help me understand the market and what's going on from an economic standpoint and what's going on from a real estate standpoint. And then once I say, yeah, that looks like a good market, then I look on Redfin and I see what's sold in the area. I just cut and paste the address of the property into Redfin and I look at the comparables. I just divide the, appraisers. This would drive an appraiser crazy. This
per square foot. Tell me per square foot, right? No,
for an appraiser, this would be blasphemy. But I just get a price per square foot and I compare it to what this is price per square foot, and I ask myself, is this feasible? Is what they're doing within the realm of possibility? And
you've been doing this for how long, Ryan?
3.5 years.
Oh, fascinating. All right, and have you had any? How has your learning evolved over that 3.5 years?
That even though a property may look, it's got a lot of gingerbread and it looks really cute, that doesn't necessarily mean it's going to be a good deal. It might look very shabby and run down, but if the numbers behind it make sense, then I invest.
Interesting. And how often do you buy a new deal? Do you invest in a new deal? And just to be clear, Groundfloor also allows non-accredited investors to invest as well, doesn't it? So what's their minimum? And what's been the range that you've invested in any one deal in nominal dollar numbers?
So their minimum is $10. It's very low.
That's amazing.
Anybody can get in on a Groundfloor deal. And that's the beauty of of these crowdfunded platforms, these crowdfunded real estate platforms, is non-accredited investors can get into the game. They can get into the action, and they can earn good returns without having to be worth $1 million or make $300,000 annually.
Right. And so what's been the range that you've invested in individual deals? You don't have to tell me any of these answers if you don't want, but the kind of, yeah.
It's been as low as $20. If I don't have a lot of faith in that, but it's like, oh, it looks good, but I don't know, I'll invest as low as $20. I've gone much higher, but if I had more confidence, if I knew the background of the house flipper, and I knew he wasn't just going to walk out on me and throw up his hands, if Groundfloor would allow me to know that stuff and the project, and if I thought this project was feasible, I would invest a lot more. But I don't, so I go very conservative.
Interesting. So you don't know who the borrower is then in Groundfloor?
No, they give you a name, but sometimes it's just an LLC or a principal. I don't know much more than that.
So you're unable to do that research. All right. Now you mentioned also that before we started, you said, well, am I interested in your thoughts and experiences of other platforms? Well, heck yes. So do please share and share alike. What are the other platforms you want to talk about?
There's one called Peer Street. I've invested on Peer Street. That's another lending platform where they lend money. I haven't had as good of results on Peer Street. I had one loan that paid back up to the 23rd month, and then they foreclosed. But I broke even on that because it paid like clockwork before that. But there's Peer Street, another good one for non-accredited investors. And by the way, Peer Street has a higher minimum. They have $1,000 minimum. Another one that's the new kid on the block, and this is an equity platform, is Arrived Homes. They're headquartered in Seattle, I believe. And it's Jeff Bezos who's the money behind Arrived. They have a really great platform. And what they do is they buy a house, and then they open it up for non-accredited investors to invest equity. So you get an equity stake in the house for as little as $100.
And then how do you generate revenue from it? Are these rented? These are rented?
They're rented out, yeah. They're rented out, and they just recently started short-term rentals too. So there's some in Scottsdale and one I saw in Nashville. What I like about Arrived also is they do a really good job in focusing in on the best markets. I really like their markets. I still do my due diligence behind the scenes, but I know that they've got good markets.
So Peer Street is also one of the earliest, actually. They're one of the earliest adopters of crowdfunding. They also lend, actually, no, Peer Street are different. Peer Street buy loans, don't they? From hard money lenders around the country. There's kind of a secondary market.
Yes, that's what they do, yes.
And what about Patch of Land? Have you had any access to them? Have you worked with them?
I have not worked with them. I've read about them, and I've looked at their website, but I have not invested on them. There's other ones. There's one called Roofstock. There's a lot that are popping up. I really can't speak to the other ones.
So what attracted you to Groundfloor then, relative to these other kind of fix and flip lender platforms? What was it that Groundfloor attracted? What brought you to them, and what attracted you to them in the first place?
So they mainly invest or buy loans, lend, I should say. They mainly lend in Georgia, which is where they're headquartered, and Florida, and a few other markets around the country. And I like those markets. The greater Atlanta area, there's some really good spots to invest in and around Atlanta. Another issue is foreclosure laws. You want to be investing in states that have favorable foreclosure laws. And Georgia is one of those states.
Right. So if you do have to take a property back, you don't have to go through the courts and spend years trying to get it. That's the
Yeah,
plan.
they have non-judicial foreclosure.
Right. So it's, what is it, 30, 45 days or something, and you get it back.
Yeah, it's quick.
It's very fast. Ryan, all right. So you also told me that, or your LinkedIn profile, we chatted about it briefly. You were or are a rich dad coach. What is that exactly? Teach me something about, like, tell me what is it, and give me some kind of high level, super advice from Rich Dad.
So the Rich Dad, I was a Rich Dad coach for over a decade. I'm not currently. For those who haven't heard about Rich Dad, it's a book written by a man named Robert Kiyosaki. And Robert Kiyosaki grew up in Hawaii, and he had two dads. One was his real dad, and the other dad was his best friend's dad, but they grew to be really close. One dad was rich, one dad was poor. One dad had a PhD, the other dad had an 8th grade education. And the moral of the story is that Rich Dad was the guy with the 8th grade education, and poor dad was the guy with the PhD. No knock on anybody with a PhD.
No, I know. I tell you something, I'm having a PhD is great. When I got my PhD, somebody said to me, "Oh, what are you going to do with that?" I'll frame it. Put it on the. What else to do with it, really? Yeah. Anyway, go on. Rich Dad, Poor Dad.
And so Robert Kiyosaki, he wrote this book called Rich Dad, Poor Dad, and about why he decided to follow in his rich dad's footsteps rather than his poor dad's footsteps. And he's written, you can see the books behind me. I've got a whole bookshelf full, and the Cash Flow board game as well. But I first read these at age 21 or 22, and I dived in. I really love the Rich Dad philosophy.
Well, so what is it then? What is the kind of, what are the key, when you do an introductory call to try and sell somebody, right, on taking your coaching, what do you tell them? Why should I be?
It's all about thinking differently, thinking outside the box, thinking like an entrepreneur with an entrepreneur's mindset. And Kiyosaki was very successful in real estate investing, as well as different business ventures he was in. It's, I'll give you one example. There's something called the cash flow quadrant. Mm-hmm. And the cash flow quadrant, there's the E, S, B, and I. E stands for employee, S stands for self-employed, B stands for business owner, and I stands for investor. On the left side of the quadrant, on the E and the S side of the quadrant, E's and S's think differently than B's and I's. And they're taxed differently as well. Employees pay half of their payroll taxes, whereas the self-employed person pays all of their taxes, their payroll taxes, their self-employment taxes. On the B and the I side, Warren Buffett says that his secretary pays more in taxes as a percentage of her salary than he does. And that's because he's on the right and the right side of the quadrant with the business owners and the investors. And so we would just talk about how you want to move from the left side of the quadrant to the right side, where the business owners and investors live.
Fascinating. All right, so let's go back to Groundfloor again. We're going to wrap up. I've got 3 quick fire sign-off questions I'm going to ask you in a minute. Not right now, but they're quick fire. But I do want to get back to Groundfloor. I got a question I'm dying to know. So I'm not going to ask you how much. So when you invest, you're saying 50 deals, right? So you got 50 deals. I'm presuming at any one time you're invested in 50 of their deals on their website. If you're investing 2% maximum, in any single one deal. So just using that number as a basic. I'm not going to ask you how much you've invested or have invested overall. That would be very personal. So my question is instead, if you were to come into money, right? You win the lottery or something, an uncle dies and leaves you the farm somewhere or in the big nest egg. Would you invest plus 10 on, if you could add a 0 to your total, let's say you've invested 100,000 at any one time or whatever that number is, would you add a zero to that? Would you 10x it because you're that confident in your coverage of the ground floor plus track, or 10 or 100x it? Like, would you invest even more? Like, somebody listening in thinking, well, I've got $1 million. Should I mimic what this guy's doing at Groundfloor and follow his investments, or like, how confident are you? And that's what I'm trying to get to.
That's a great question, Adam. That's a really good question. It comes down to, I would certainly invest more, no doubt about it. But for people who have a lot of money that they're working with and trying to put out there, I think the bigger crowdfunded platforms are the way to go. The big ones that you've had on your program, the Crowd Streets, those big ones.
Right.
Probably just from a time management standpoint too. There is some time that's involved in researching these deals. Yeah.
Interesting. All right, so let's move on to, and I do have a question I'm going to ask it offline afterwards. And if, depending on what we say, I'll actually mention it in the intro and outro. Let's wait for that. Let's finish up with 3 final sign-off questions, just rapid fire questions, all right? Ryan, what are the daily habits that you have, personal daily habits, that keep you productive and successful?
Every morning I go for a walk. It allows me to clear my head, and I get out in nature and I listen to your podcast, and as well as others. And so that's my first one. Get out, get some exercise, do something. The second is always add value. Ask yourself, how can I add value to every situation? Not how can I take, but how can I give and add to everyone in the transaction.
Very nice. Second question, rapid fire, last questions. What's been the hardest lesson you've learned in real estate?
So I bought a property actually right after I read Rich Dad Poor Dad for the first time in my early 20s. And I didn't do my homework. I didn't know what homework to do. I just went out and bought this property, and it was a ball and chain around my neck. It was an albatross. And real estate can be very good when it's good, or it can be really bad when it's bad. And I used to wake up with nightmares. I'd have nightmares about this house, about my tenants and how they were ruining my house. So that's why I love real estate crowdfunding. It's because I sleep great at night. I don't have to worry about what's happening because I've invested in small amounts of money in each property. So if one goes bad, I'm not ruined.
Fascinating. That's a really interesting story. Last question. So I'm just going to contextualize this a little bit. Inflation is biting, stock market is down, interest rates are going up, property prices are coming down. We're heading into, if we're not already in a recession, it's like the world is upside down. So for an investor listening in now, who's wondering what the heck to do with life and thinking about real estate, what advice would you give them?
Follow the fundamentals. The fundamentals. That is a good market, a growing economy, population growth, people are moving in. By investing in those areas, you can't go wrong.
Ryan Windley, real estate investor. What an enormous pleasure to me. You're a very nice fellow, and it's a real pleasure to talk to you and to have you on the show. Thank you for joining me.
Thank you, Adam. I appreciate the opportunity. And as far as the crowdfunding industry, I think you're going to be up there at the pantheon of crowdfunding gods with the likes of Woody Ness.
Oh my goodness, Ryan! I think I'm going to have this particular episode of the podcast bronzed. Thanks so much. You're far too kind. Thank you.
Thank you.
Right. So here is the epilogue for today's podcast. Of course, Ryan and I started talking about stuff, off the record, and now here we are back on it. Ryan, your newsletter. Tell us more about that.
So what I have is a website, and I've played around with it on and off over the years. But what I've done is I have condensed my whole strategy into an ebook, and you can download that ebook for free on my website. The website is realcrowdcoach.com. That's real crowd coach, like real estate crowdcoach.com. And anyone can go on there, sign up, and download the ebook for free. And it's the nuts and bolts of what I have done a poor job in explaining during our conversation.
Hardly. You've done an exceptionally good job, I think.
And you can also follow me or contact me on LinkedIn.
Right. Okay. And I'll put these links onto the website. Now that we are back on the record, I am going to ask you this. So do you ever share with people? So the reason I was asking about a newsletter was because I would certainly like to know. I don't want to spend any time figuring out and doing research on 50 deals at any one time on any platform, crying out loud. But I wouldn't mind following the deals that you're doing if you're doing the research. Do you offer insights into, all right, I'm investing in this deal today, I'm investing in this one, I'm investing in this one. Obviously, you can't recommend it because you're not a broker-dealer, but if you have a newsletter, you can certainly talk about the deals that you're investing in. Do you do that?
I've thought about it. I've posted some on the website, but if you think that would be a good idea, I'm intrigued.
All right, well, maybe that's something we can chat about a little bit. Anyway, let's wrap up then. Thanks so much, Ryan. This is really the true final. Thank you for telling us about your website and how people can get to you. Appreciate it. That was private investor Ryan Windley discussing how he reduces risk while increasing returns investing on the Groundfloor crowdfunding platform. To learn more about Ryan, go to the podcast page at gowercrowd.com. And while you're there, click on the subscribe button at the top of the page to gain access to our free weekly newsletter. We're the only website exclusively dedicated to real estate crowdfunding and syndication news and updates, where you get information and resources you can use immediately. Subscribe to our newsletter. It is totally free right there at gowercrowd.com. That's it. Thank you so much for joining me, Ryan Windley. It was a real pleasure to meet you and to hear your story and ideas. And thank you, dear listener. I hope you found today's episode as interesting as I did. That is all for today. Be well, stay safe, and for now, this is Adam Gower signing off.